My name is Jeffrey Kennedy and welcome to Trader's Classroom. How does the wave principle actually allow you to forecast future price movement? Well, the simplest and most basic answer is twofold actually. The way it classifies price action and also to the Elliott wave patterns, which is exactly what we're going to be discussing in today's update. So let's begin. Now, as you know, the Elliott wave principle classifies price action into two distinct modalities: motive waves and corrective waves. Now, there are only 5 core patterns that we work with as Elliotticians. Everything else stems from those 5 core patterns. And those 5 core patterns are the impulse wave, the ending diagonal, the zigzag, the flat, and the triangle. Then, of course, you know that motive waves, there are only 2 types. That's the impulse wave and the ending diagonal. And as far as corrective wave patterns, we have 3: the zigzag, the flat, and the triangle. Now, each pattern has its own specific set of rules and guidelines. Now, what I have diagrammed in front of you is what we call an 8-wave or a complete 8-wave Elliott cycle, meaning that we have a completed impulsive move to the upside and also a completed corrective decline to the downside. This essentially consists of 8 waves. Waves 1, 2, 3, 4, and 5, and this would actually be 6, 7, and 8. That's how we actually come up with this 8-wave cycle. But this 8-wave cycle, and again, the ability of the wave principle to actually classify price action accurately and consistently, in addition to the meaning obtained from the corrective wave patterns, again, the zigzag, the flat, and the triangle, actually allow us to kind of get a good idea, actually a great idea, of moving forward, what we can anticipate moving forward. This allows us to actually forecast. And then we take the next step and take that forecast and then develop a trade plan that then allows us to take advantage of what we expect in the markets. For example, let me just eliminate that title right there and eliminate this, and let's move the price action over to the right, or this diagram to the right. Okay, well, this is going to be an initial move to the upside. Now we can identify this as wave A or wave 1, it doesn't really matter. But this is an impulsive move, and this impulsive move will actually subdivide into 5 distinct waves. All impulsive moves, waves 1, 3, and 5, break down into 5 distinct waves. Well, at this juncture, what can we expect? Well, according to the guideline of depth of corrective waves, whenever a 5-wave move is complete, there's a correction then occurs, a retracement in price. So then that gives us our wave 2, or in this instance here, because we don't have confirmation yet that wave 3 is developing, we can identify this as a wave A or wave 1, and this pullback wave B or wave 2. Now, the really core distinction between counter-trend price action and impulsive price action, again, twofold. Number 1, impulsive moves consist of 5 waves. Counter-trend moves, corrective wave patterns, consist of 3 waves, specifically the zigzags and the flats. Also, 2, impulsive price action is very sharp. It has a very steep slope, either to the upside and or to the downside. Corrective price action tends to be very time-consuming, also contained within parallel lines that have a very, very shallow slope. Because this is a counter-trend move, this tells me that the larger trend is still to the upside. So I can now anticipate an advance in this whatever market, XYZ market, back to beyond this extreme. And as you can see here, prices do advance. This move to the upside certainly surpasses equality with the initial move up, which is important because the most common relationship between, say, for example, wave C and A and a zigzag and a flat tends to be equality. So now we have confirmation of wave 3. Of course, this being an impulse wave, it will also subdivide once again into a smaller 5-wave structure. Once this wave 3 is complete, once we have 5 waves within this advance, what can we then anticipate? Again, we apply the guideline of depth of the corrective waves, which states that we now can expect a counter-trend move. Moreover, we can apply the guideline of alternation, which states that alternating waves, in this instance here, for this example, specifically waves 2 and 4, tend to alternate in their form and structure. For example, I've identified this move down, wave 2, as a zigzag, which would argue or increase the probability quite high that your 4th wave move move will unfold as a flat correction. So we have a flat pattern here. Now, because the larger structure we're working to the upside here is an impulsive wave, we already have waves 1, 2, 3, 4. Now we can anticipate further rally back to beyond the extreme of wave 3 as we see wave 5 develop. Once we have a 5-wave move within this structure, or possibly an ending diagonal in your 5th wave move, well, again, what can we anticipate? We apply the guideline of depth of corrective waves, which states that whenever a 5-wave move is complete, we then pull back into the span of travel, typically of the prior 4th wave, most often ending near its terminus. That would be this extreme right here. Also, too, because we're working a larger structure to the upside, and this 5-wave move to the upside could be a higher degree wave 1 or a higher degree wave A, then we'll be looking for, of course, a larger degree counter-trend move. So this would be our wave A, B, and C. Again, I've identified this move as a zigzag. Each pattern has an implication. Each pattern has a meaning. For example, again, motive waves, they tend to denote the direction of the larger trend. Corrective wave patterns, well, those are counter-trend moves. Those are your opportunities from an analytical or trading perspective to rejoin the larger trend. So let's look at a few price charts, and we'll start with this one here. This is NVIDIA. Ticker symbol is NVDA. Now, rather than starting, say, from the very, very left-hand price chart and really working on trying to identify each one of the structures here, let's do a quick trick here, okay? What I'd like for you to do is simply focus on the price action in the box, okay? Well, why is this important, just this price action that I've identified in the box here? Well, we definitely have a sharp move to the upside. And then the move to the downside, nice, and it actually comes back and closes the price gap. This is a nice impulsive structure. So really what we can actually do is just follow what's in the box moving up higher here, and that allows us to make, again, confident forecasts moving forward about the market. So if we identify this move here, well, let's even go back a little bit farther. What I've identified in the yellow price box. Does this look like an impulsive structure? Okay, an impulsive structure, again, is a very sharp slope, and it consists of 5 waves, just like I've identified in the prior move. Let's go back to this diagram. This is an impulse wave, waves 1, 2, 3, 4, and 5. Now, if we were in a bear market, we'd be looking at 5-wave decline, something that had the same structure, but to the downside. Okay, if we go back to this slide here and simply focus on the counter, on this move price action, does what I have highlighted in yellow actually look like a bearish impulsive decline? So we certainly wouldn't go 1, 2, 3, 4, 5. Of course not. This is choppy, sloppy, slow price action, holds prior structural or chart support. So this is a counter trend move, thus we can expect it to be more than fully retraced. And as you can see, what's actually happened in NVIDIA, that movement has indeed been fully retraced. Here we had the big sharp move up, came back down, closed the price gap. We know price gaps many times offer trading possibilities as far as their retracement, or what we call closing the price gap, and it most certainly did. So also, too, another trick we can do is apply what we know about counter-trend price action. Counter-trend price action tends to be contained by parallel lines. As you can see here, the structure in NVIDIA to the upside certainly is not contained by parallel lines. We had this breakout above the upper boundary line of the corrective price channel, thereby confirming the presence of third-wave price action. So if we go back to our slide here, of how we can actually utilize the wave principle to forecast future price movement, let me show you where I think we actually are in NVIDIA. Okay, going back to NVIDIA, close the price chart, and just look at this form right here. Just focus on this. Okay, now let me show you where I think we are. Doesn't price action in NVIDIA look like what I've highlighted here in the diagram? Sharp move up, pull back, and a big move up in wave 3. Okay, this is exactly how the wave principle allows us to forecast future price movement. 1 up, 2 down, that's a 3. So what can we now expect? We have waves 1, 2, and 3 to the upside. Okay, well, going back to the core Elliott wave patterns, again, going back to this diagram, if we have waves 1, 2, and 3 up and done in NVIDIA, well, now we can actually anticipate this fourth wave counter trend move. And as you can see from the next slide, this is exactly what I'm looking at. And actually, I like that price gap down here. Notice how we came down and closed the price gap and then reversed? Possibly on this fourth wave pullback, we'll see just pretty much the same thing. Also, too, we can begin to apply our Fibonacci retracements. As you know, the most common Fibonacci retracement for a fourth wave is a 382 multiple of wave 3. That comes into play at 27.38. We have a price gap here. Trend seems deeply ingrained in this market because of the impulsiveness of the move to the upside. So we may want to keep an eye on the 236 retracement. So a pullback probably maybe into the first week in December or possibly the second or third week in December would actually look like a wave 4 counter trend move. So it's really the patterns of the wave principle and its classification of price action which allow me to make confident forecasts for future price movement. Now sometimes I'll be wrong. Sometimes the assessment I make on a price chart is incorrect. But what's important to understand is I simply was incorrect in identifying, say, a specific pattern. It doesn't, I think, negate or take away the true value of what the wave principle does indeed offer, and that's a high confidence approach to looking at the market that allows you to make a very high probability forecast for future price action. Now here's a price chart we've looked at recently, Micron Technologies. Okay, where are we at within this price chart? Well, if we just go ahead and put on our box here, let's look at how price action has unfolded for quite some time. Now we have that big acceleration gap. Again, from our work on price gaps, this is an acceleration gap. That tends to denote the center or the mid portion of your wave 3 of 3 decline. What about this price action right here? What I've highlighted in the box, the up-down-up sequence. Well, if the prior move to the downside is a 3-wave move, and as we know, impulsive moves, waves 1, 3, and 5, always subdivide into 5 smaller waves, then that would argue that from this extreme here, we have waves 1, 2, 3, 4, and 5. So this low here would actually represent a wave 3 extreme. So where we are at this low in Micron Technologies actually equates to being right here in our Elliott wave 8-wave cycle diagram. Okay, well, what happens after a wave 3 is complete? You see a counter trend move in 4. Well, here's our counter trend move. So where are we now? Well, at this extreme here, I'm trying to get my arrow on the price chart. So at this extreme here, we're actually at the inverse of this point right here. So now we can anticipate wave 5 to a new extreme. In this instance here, going back to this price slide of Micron Technologies, here's the actual Elliott wave interpretation. Here we have waves A, B, and C up and done. And since we've already identified a 3 and a 4 in the market, let's go ahead and put our wave 3 extreme right here. And we can put our wave 4 extreme right there. So now we can anticipate a move to the downside, making new lows below the wave 3 extreme, because those go back specifically to the rules and guidelines of the Elliott wave principle. Now, the true value of the wave principle is, as we've now identified this price action on this price chart, I have a good forecast, an Elliott wave-based forecast, based off the patterns and based off the wave principle's ability to classify price action accurately. So what I'm now looking for is a 5-wave move to the downside. Again, each impulsive move, wave 1, wave 3, and wave 5, subdivide into 5 smaller waves. I now have a prescribed path moving forward, or what I sometimes call an Elliott wave script. Okay, well, that script is not fuzzy. It's not black and white. It's typically very well defined. It's black and white. In this example here, what I'm looking at is waves 1, 2, they're already in place. We're working wave 3 to the downside. Where am I wrong? That's a very important question, not only from an analytical perspective, but also from a trading perspective. I don't want to see prices exceed the extreme of wave 2. Why? Well, if prices exceed the extreme of wave 2, that actually turns this sell-off into a larger three-wave decline. And what do we know about three-wave moves? Three-wave moves are counter-trend moves. So if we exceed the extreme of wave 2, odds are this isn't an unfolding impulsive decline, but it actually argues for further advance, maybe back up to close this price gap. So what the wave principle does, it allows me to forecast future price movement based on the patterns and based on the wave principle's ability to classify price action. More importantly, it gives me parameters to work with. And as long as price action unfolds within those parameters, I'm on track, I'm on course. If we deviate from those patterns, and that's a warning sign, and again, very important from an analytical or trading perspective, because then I can actually manage risk on the position. Now here we have another price chart that I've actually identified this move here as a contracting triangle. Well, what's the meaning behind a contracting triangle? What's the meaning behind a triangle? Again, each pattern has a meaning and a purpose. And if you understand its meaning and purpose, it gives you a great idea of what you can anticipate moving forward. Now, a triangle can only occur or form in the wave 4, B, or X position by itself. In this instance here, I've identified the entire structure as a triangle, which means that this move, this triangle, is either a wave 4, a wave B, or a wave X. Well, because we don't have a W in front of it, odds are it's not an X. I seriously doubt this is a B wave, a triangle B wave of any type. And considering the larger sell-off that we've experienced in GMCR, Green Mountain Coffee, I would argue or suspect with a high degree of certainty that this is actually a fourth wave contracting triangle. Well, what's the significance of a fourth wave contracting triangle? It always precedes a final move down, which will be your fifth wave. Triangles always precede the final move of a sequence. So a triangle 4 leads to a final fifth wave move up. A triangle B wave is followed by a final C wave move up or down. And a triangle X wave precedes the final wave Y structure of that corrective combination. So what does this information tell me? Well, this information tells me from a trading perspective that I may want to, at this point here, if I've been short the market, I maybe want to lessen risk, tighten stops, maybe begin exiting a certain size of the position. It lets me know that the downside's limited, and really the next big move is going to be to the upside, and again, nice attractive price gap right here. So that may not be a bad target for a sizable move to the upside, either as a new impulsive structure and possibly even a larger corrective structure. Let's look at one more price chart. Okay, what do we have here in this price chart of American Airlines? Well, the thing that caught my eye about the price chart of American Airlines is actually twofold. Number one, the move to the upside. Up, down, and up. There's only three waves. Well, counter-trend corrective wave patterns, specifically the zigzag and the flat, consist of only three waves. One of the key characteristics of counter-trend price action is that it tends to be contained within parallel lines, as this is. Okay, what about the prior move to the downside? Can we glean any information from the prior move to the downside? Well, I believe we can, because what we have here is we have a very impulsive move down initially after the double top. There's our double top. We have an initial move to the downside. Then we have a counter-trend move up. Then we have a larger decline. And another counter-trend move up. Notice we don't have any overlap. That's one of the rules that is pertinent to the impulsive structure, that you can't have overlap between waves 4 and 1, or more specifically, wave 4 may never end in the price territory of wave 1. So it looks like we actually have an impulsive decline followed by a counter-trend move to the upside. So this 5-wave decline could be wave A or wave 1. So within going back to the original diagram that we were working, where are we within the diagram in American Airlines? Well, we have the impulsive move to the upside. Well, let's just go work with this structure over here to the right. We have an impulsive decline followed by a three-wave counter-trend move. So where we are in American Airlines is really this area right here. 5 down followed by a three-wave counter-trend move. Let's go back to the price chart. We have a 5-wave decline followed by a counter-trend move. So if we apply, again, the meaning behind each one of these patterns, because this is a counter-trend move, I'm actually looking for it to be more than fully retraced. Now you'll also notice from this price chart, I'm identified this extreme and this extreme as waves A or wave 1. Well, why don't I just go ahead and say it's wave A? Or why don't I identify it as wave 1? Well, there's not enough information as of yet to confirm a wave 3 decline, so I always start off with the least aggressive interpretation until I have price action to confirm otherwise. So we're going to work with the idea that this is a wave A decline, wave B counter-trend move. Then we can anticipate, say, an equality move to the downside, from the extreme there to the extreme here to this extreme, and that gives us an equality measurement 2543. That's where wave C would equal the distance traveled in wave A. Again, going back to the wave principle, these patterns lead to additional patterns. For example, if we have a zigzag, regardless if it's wave 2 or wave 4 or wave B, if we can see a zigzag in a market, that tells me at some point ultimately that move will be more than fully retraced. Now going back to this example here, where are we in American Airlines? By following the pattern, this allows us to make a forecast in American Airlines moving forward because we're right here. We have the 5-wave decline, we have the 3-wave counter-trend move up, we have the 5-wave decline, we have the 3-wave counter-trend move up. So the focus for forecast moving forward is for a sell-off back to below this extreme. Okay, again, where am I wrong? This is where the rules and guidelines of the wave principle come into play and make it, I think, the wave principle, in my opinion, very, very valuable because I know precisely where I need to abandon this idea altogether, and that would be if prices exceed this extreme, because that means we have a serious deviation to the operative Elliott wave script moving forward. I now have a place to change my mind. Now that's one of the things that I don't see very often in your technical studies, say RSI or MACD or stochastic. It doesn't tell me to the tick or pip or penny where an interpretation or where a forecast needs to be abandoned or totally reevaluated. Well, that about does it for today. I'll see you tomorrow. Thank you very much.